Market, the bulls are trying to fight back real hard. They still have about 13 minutes to go before the day closes out. Anuj, that's not a move that you can ignore that easily, because that's been a remarkable comeback, right?
Oh yes, and this is just a market in which you got to just on days like today especially. Remember we discussed that 1 hour still to go, and things could change in the market, because this is a strong market in which all dips are buyables. I mean, just look at, for example, a Bharti Airtel, so to be. It's about strong stocks, which keep getting bought at every level, and right now as we speak, look at that move now on Bharti Airtel.
HDFC, I just want to point this out. My God, what a bar on HDFC right now. Just as we're getting into the last 10 minutes of trade.
Yes,
that's a big one.
That's a big one, HDFC Limited, and actually that's the one which has really carried the market now. In fact, just pull out the contribution plate and you would see that that's a big move happening on that, along with Infosys and a couple of other stocks. So I think, again, same verdict, that basically you got to buy the dips. Sometimes the dips can be fancy, 10, 15, 20 points. In today's case, the dip was a bit more fancy. It gave you about 50 points. I think it was lapped up.
It's Christmas season, I think. So who knows? Green or red, both colors might just turn into the green by the time this thing closes out. Hemang Jani is with us on this leg of the show. Hemang, it's been a very, very stunning pullback. And actually, I do want to talk to you about the HDFC twins, much loved stocks of the market. If you were to buy one at these current valuations will always be elevated for them. Which would you pick?
Hi, good afternoon, Surabhi. I think both of them have done pretty well, but if one has to choose one, then I think that somewhere in terms of the valuations, and particularly the valuations of some of the subsidiary companies, HDFC Limited looks a little more compelling, because the kind of subsidiary valuations that they have. And at some point, market is willing to give that additional, valuation for a quality company, and the fact that the core housing business per se, because of the kind of grind that we've gone through in the NBFC space, HDFC Limited would be in a better position to gain the market share with a much better spread, etc. So from that perspective, I think HDFC Limited looks good, but of course, both HDFC Limited and HDFC Bank, if one is holding on to the portfolio, I don't think we really need to worry whether X goes up more or Y goes up more. It's all doing pretty well.
Okay, that is HDFC and HDFC Bank. Now, let's get you some more market opinion, and this is coming in from some of the biggest voices in the market. And this, of course, is towards the end of the year. As we count down to the end of 2019, the main question that lingers on investors' minds is the road ahead for the market and the key themes to bet on. Big market voices, Rhythm Desai of Morgan Stanley, Surendra Goyal of Citi, and Gautam Chacharia of UBS in conversation with Lata Venkatesh and Anuj discuss some of these key themes and trends for 2020.
In large part over the past 5-7 years, the earnings also have been concentrated. Market performance concentration is only a reflection of earnings concentration. So large companies have done reasonably okay. In an economy that is struggling, they didn't have debt to start with, and they've gained share. We have had GST. We have had a lot of few things that have helped large companies gain share. So if the economy recovers, then I think you will see that valuation gap narrow. Therefore, our headline position on India is buy domestic cyclicals, buy value stocks, and buy mid caps. And if you can combine that, which is cyclical, value, mid cap, I think that will be the combination that I think will work in 2020.
In 2020, Rhythm, you are extremely bullish, and I think especially on the mid and large caps, one part of the Indian bullishness came after the corporate tax cut, right? Do you think that will be the genesis of this call, and do we need to do more in budget, say even a personal income tax cut, to sort of further back this in 2020?
Yeah, so bear with me for a few seconds. The corporate tax cut, let's not make any mistake, is a massive change. It wouldn't have happened had the economy not gone to 5% and sub 5%. So thankfully it did that, because otherwise we would not have got such a big change so dramatically. But I think there is more policy needed. So it's not enough. It's a very big move, but let's not underestimate the move. But I think there's more work to be done. We need to continue transfer resources from the public sector to the private sector by using the government's balance sheet. So the government needs to monetize assets and transfer resources to the public sector, including, my view is, double the income for farmers, because farmers are in great pain and food prices are not likely to go up on a secular basis. We need to continue to improve our terms of trade with the rest of the world, so attract more FDI, maybe even consider inclusion in the global bond index, and also get the trade deals done. And I think we have to be paying attention to the monetary and financial system, where there is more work to be done by the RBI, because I think interest rates can actually go down a bit more.
Okay, Surendra, you actually are not as positive on the market. I think I'm looking at your strategy note. You have a 2020 Nifty target of 12,700. It may actually happen in December itself, the way the market is going. So, in that case, 2020 calling for a flat market?
Yeah. So I think a couple of things to really focus on there. Firstly, if you look at earnings, while there is an expectation of a recovery, the multiple that we are talking of 18.5, 19 times is already building in 25%, 30% earnings growth, depending on whose numbers you look at on the Nifty. So it's not like the numbers have not already been built in.
This 25% you're expecting for FY21, you think is built in?
Yeah, yeah. So now what happens? So again, it's FY21, absolutely. So that's built in. So now what we have been seeing over the years is we always start the year high on earnings expectations, and then the disappointments come in. And our top-down view still remains that this bottom-up number, which analysts are penciling in, of 25% will end up being on the aggressive side, given the kind of overall growth outlook that we are seeing. So if that does not come through, I think that is what one needs to keep in mind. In our view, a lot of upside has gotten priced in. Having said that, I would definitely add that global returns are an important part of where the market ends up with. Like this year, if you are just looking at India, you feel India has done well, double-digit returns, but when you compare it with other markets. So, like if you just look at this year, we had say roughly 12 billion of foreign flows till date. We have had roughly 12 billion of money flows coming into domestic mutual funds. So that itself is a lot of money. So if those kind of trends continue, you could get more upside, but I think the earnings story is important. And in our view, a lot has gotten already priced in.
Okay. Well, I'll just come back to you. If your 12,700 is modest, this UBS view of 12,300 by June is outright pessimistic. Okay, bearish under the circumstances, but yes, a swing can always bring it down. Why are you so bearish?
So I won't say bearish. So this is target set few months back. So we've been constructive for the last few months. And we look at markets from both risk-reward perspective as well as broad and narrow markets. So risk-reward perspective with a 12,300 base case target for June 20 and our upside downside, clearly the risk-reward is not attractive anymore at this level for us. Having said that, we are assuming gradual stabilization in the economy. What's still unknown is whether we see policy moves for a sharper, quicker recovery. If that happens, then there is upside to the markets. Otherwise, it's getting fairly priced now. The second point I would highlight here is we have been underweight small mid caps for the last couple of years. We still remain so for the next few months. It's still too early to get bullish on small mid caps despite the widening valuation gap with the large caps. Because for small mid caps, typically you need a much more clearer visibility of actual recovery. Hopes are not enough for small mid caps to rally.
And you don't see it on the ad?
It's too early. So from a 2-3 year perspective, we'll get actual recovery, yes. But in the 6 to 12 months, we haven't seen enough policy action till now.
And you can catch that entire very interesting conversation today at 5 p.m. only on CNBC-TV18. So it's a tantalizing fight to the finish. 12,270 is what we have. Need to take a very quick break. We're going to